A lot of people think they need every single ICT concept to align before taking a trade. And because of that, they end up missing many good setups. It also leads to what is commonly called analysis paralysis. In this video, I'll be teaching you how to combine different ICT concepts to build your own entry model. These are the 7 concepts we're going to work with, and we'll mix and match them to create different entry models. The first concept is the liquidity sweep. The second is market structure shift. The third is the fair value gap. The fourth is the inverse fair value gap. The fifth is SMT divergence. The sixth is breaker blocks. And the final one, the seventh, is the balanced price range. What we're going to do is combine these concepts in different ways to form structured entry models. In this video, we'll go through 5 of them. The first model combines a liquidity sweep, a market structure shift, and a fair value gap. The second model uses a liquidity sweep and a balanced price range. The third model combines SMT divergence, a market structure shift, and an inverse fair value gap. The fourth model uses SMT divergence, a market structure shift, and a breaker block. And the fifth model combines a liquidity sweep, a market structure shift, a breaker block, and a fair value gap. Now, just because we're covering 5 models doesn't mean you should trade all 5. Instead, you pick the one that fits your personality and trading style, then backtest it properly. Let's now break down each entry model one by one. The first model is the combination of a liquidity sweep, a market structure shift, and a fair value gap. For this, I created a simple checklist. First, you wait for a liquidity sweep. After that, you wait for a market structure shift. Once you get the structure shift, you then mark out the fair value gap that price left behind. That fair value gap becomes your entry area. You set your entry there and target a 1 to 2 risk to reward ratio. Most of the time, your stop loss should be placed below the fair value gap low or below the candle that created the fair value gap. Now let's head to the chart. I'll jump into Trading View and show you both a bullish and a bearish example of this entry model. Now here we can see a bullish example of this entry model. First, price gave us a liquidity sweep right here. After that, we got a market structure shift, and then price also left behind a fair value gap. Our entry is set at the fair value gaps. The stop loss goes below the candle that created the fair value gap, and we target a 1 to 2 risk to reward ratio. And as you can see, price tapped into the fair value gap and pushed straight to take profit. Now let's look at a bearish example. Here we can see a liquidity sweep first, followed by a market structure shift. After that, price once again left behind a fair value gap. So our entry is taken from the fair value gap. The stop loss is placed above the high of the candle that created the fair value gap, and we target a 1 to 2 risk to reward ratio. As you can see, price tapped into the fair value gap and pushed directly to take profit. Let's now move to the second entry model. Here, we're going to focus on combining a liquidity sweep with a balanced price range. Here's the checklist. First, we identify a liquidity sweep. Next, we wait for price to inverse a fair value gap. After that inversion, we then watch to see if price creates an opposing fair value gap. Once that happens, we can set our entry and target a 1 to 2 risk to reward ratio. Now, this is how it looks on the chart. First, we get a liquidity sweep. After that, price clearly disrespects this bearish fair value gap. When we extend that fair value gap across, we can also see that price created a bullish fair value gap in the exact same area. That overlapping zone is what forms our balanced price range. From there, we can take our entry, place our stop loss just below the low, and target a 1 to 2 risk-to-reward ratio. This is a very clean and effective entry model, and it's one you can apply consistently. Let's go to TradingView so I can show you how this looks on a live chart. Now let's look at a bullish example of this entry model. First, we get a liquidity sweep. Price takes out this low. After that, we can clearly see a bearish fair value gap and a bullish fair value gap overlapping each other. That overlap becomes our entry zone. We take our entry from there, place the stop loss just below the swing low, and target a 1 to 2 risk-to-reward ratio. As you can see, price cleanly reached the 1 to 2 target. Now for a bearish example. Here, price sweeps this high, giving us a liquidity sweep. After the sweep, price creates a bullish fair value gap and a bearish fair value gap, and once again, they overlap. That overlap is where we take our entry. Entry from the zone, stop loss just above the high, and take profit at a 1 to 2 risk-to-reward ratio. Price immediately hits the 1 to 2 target before reversing. This is how the model plays out in both directions. For the third entry model, we'll be using SMT divergence, market structure shift, and the inverse fair value gap. Here's the checklist. First, we wait for an SMT divergence. Once we get that SMT, the next thing we look for is price to inverse a fair value gap. After that fair value gap is inversed, we then wait for a market structure shift. Once market structure shifts, that inverse fair value gap becomes our entry zone, and we target a 1 to 2 risk-to-reward ratio. Now let's see how this looks on the chart. First, we get our SMT divergence. After the SMT forms, price disrespects this bearish fair value gap, which turns it into an inverse fair value gap. Following that disrespect, price gives us a market structure shift. Once that happens, we take our trade by setting a limit order at the inverse fair value gap, with the stop loss just below the SMT low and the take profit set at a 1 to 2 risk-to-reward ratio. This is how this entry model works. And honestly, this alone could be the only model you use, because it plays out more often than not. And if you don't fully understand some of the concepts I'm using in this video, I've created an ebook where I explain them in the simplest way possible, so simple that even a beginner can understand. I broke down everything from fair value gaps to SMT divergence, market structure shifts, breaker blocks, and many more concepts. If you're interested, you can check the first link in the description to get a copy for yourself. Now let's move on to the fourth entry model. This model combines SMT divergence, market structure shift, and breaker blocks. Now here's the checklist for this exact entry model. First, we wait for an SMT divergence. After spotting the SMT divergence, we then wait for a market structure shift. Once the market structure shift is confirmed, we mark out our breaker block. From there, we take our entry at the breaker block and target a 1 to 2 risk-to-reward ratio. Now looking at this chart, the first thing we identify is the SMT divergence, which we can see right here at this low. After that, we wait for the market structure shift, which price clearly gives us. Once that happens, we mark out the breaker block, set our limit order at the breaker block, place our stop loss just below it, and target a 1 to 2 risk-to-reward ratio. Now for the final entry model, this is also known as the unicorn setup. It combines a liquidity sweep, a market structure shift, a breaker block, and a fair value gap. Here is the checklist for this entry model. First, you wait for a liquidity sweep. After the liquidity sweep, you wait for a market structure shift. Once the market structure shifts, you mark out your breaker block. Then you identify the fair value gap. After that, you set your entry at that area and target a 1 to 2 risk to reward ratio. Now this is how it looks on the chart. First, we can clearly see the liquidity sweep right here. After the liquidity sweep, price gives us a market structure shift. Following that shift, we identify and mark out the breaker block. Then we can see a bullish fair value gap that clearly overlaps with the breaker block. This overlap forms our unicorn setup, so we can take our entry from that area. Stop loss goes just below the fair value gap within the breaker block, and take profit is set at a 1 to 2 risk to reward ratio. This is one of the most popular ICT entry models, and for good reason, but every entry model talked about in this video works extremely well on its own. All you need to do is choose one model, back test it, forward test it, and refine it to suit your trading style. If you enjoyed this video, give it a thumbs up and subscribe. See you in the next one.